In 1991, the Indian government checked its balance sheets and realized a terrifying truth. They had exactly 2 weeks of foreign exchange reserves before default. To understand how the country got so close to the edge, we have to look at the previous 40 years. Since independence, India operated a mixed economy strictly dominated by the public sector, intentionally shutting out foreign influence to protect local industry. This approach created a highly bureaucratic system known as the license Raj. If a private business wanted to exist, produce a new product, or expand its factory walls, it needed exhaustive, time-consuming permissions from the state. By protecting the domestic market through extreme isolation and endless red tape, the government accidentally built a fragile system entirely incapable of supporting itself. The country was bleeding cash through a massive balance of payments deficit. Because India relied heavily on foreign imports but had zero competitive goods to export, money constantly flowed out and almost nothing came back in. Domestically, the government borrowed aggressively to build public infrastructure. But lacking consumer goods to absorb that cash, the influx of money triggered runaway inflation. Supply couldn't meet demand, and prices skyrocketed. Completely out of money and out of time, the government approached the International Monetary Fund and the World Bank to beg for a $7 billion emergency loan. Those institutions agreed to provide the cash, but they set a strict condition. If India wanted the money, it had to completely dismantle its protected economy and open its borders to the world. To survive, the government had to execute a 2-speed pivot. They needed immediate economic triage to stop the bleeding before attempting a long-term structural overhaul. The primary triage tactic was intentionally devaluing the rupee. By artificially lowering their currency's value, they instantly made Indian goods cheaper for foreign buyers. This line chart shows how that strategy mechanically plays out. As the domestic currency drops in value, it triggers a massive, contrasting upward spike in export volume. That cheaper currency sparked an immediate boost in foreign sales, forcing desperately needed foreign exchange cash back into the country's reserves. It was a painful shock to the system, but it secured the cash needed to keep basic imports flowing. Currency manipulation stopped the 14-day countdown, but it did absolutely nothing to fix the underlying disease, an inefficient, highly uncompetitive domestic industrial sector. The long-term solution arrived as the new economic policy, built on 3 pillars: Liberalisation, Privatisation, and Globalisation. It started with liberalisation, which meant tearing down the restrictive license rush. Almost overnight, private businesses were granted the freedom to operate on commercial lines. They could expand operations, diversify products, and innovate without waiting months or years for a government stamp of approval. Next came privatization, aggressively shrinking the state's monopoly. The number of industries exclusively reserved for the public sector was slashed, from 17 down to just 3: atomic energy, railways, and defense. This animated pie chart illustrates the resulting shift in the national economy. The government engaged in disinvestment, selling off shares in its own enterprises, causing the public sector slice to shrink dramatically as private enterprise expanded. For the public companies that remained, the government granted Navratna, or 9 jewels status, giving them the operational autonomy to actually chase profits. Through these 2 steps, the engine of the Indian economy shifted away from rigid state control and towards survival of the fittest free market competition. The final step was globalization, transitioning India from an isolated economic fortress into an active participant in world trade. Decades of regulatory barriers were destroyed. Quantitative restrictions like import quotas were removed, steep tariffs were slashed, and foreign direct investment was enthusiastically welcomed. The financial sector saw a crucial shift too. The Reserve Bank of India was repurposed from a strict regulator that controlled the banks into a growth facilitator. This allowed foreign institutions to enter the market and flood the system with fresh capital. By opening the floodgates to foreign money and international products, the government forced a brutal but effective ultimatum on local Indian businesses: match international standards of quality or go bankrupt. The macroeconomic recovery over the following decades was staggering. Gross domestic product growth rates skyrocketed, and foreign direct investment exploded from a mere $100 million to over $30 billion. The combination of open borders, cheaper telecommunications, and a highly skilled English-speaking workforce transformed India into the world's premier IT and outsourcing destination. But these industrial and corporate miracles bypassed agriculture. The reforms focused heavily on industry, trade, and services, completely ignoring the sector that employed the vast majority of the Indian population. This created severe side effects. The country experienced jobless growth, a scenario where overall GDP rises rapidly without creating enough localized employment. Meanwhile, small-scale domestic manufacturers were suddenly competing against a flood of much cheaper foreign imports. The overarching national balance sheet was saved and eventually thrived, but the resulting wealth and modernization were distributed highly unevenly across the population. Today, the contrast is stark. The humiliated, bankrupt nation of 1991 operates as a global powerhouse, culturally and economically integrated, with foreign enterprise woven directly into daily life. India survived its immediate crisis through quick financial triage, manipulating its currency just to keep the lights on. But it achieved lasting power because it had the courage to strip down and overhaul its deepest structural flaws. The 1991 bailout solved the immediate debt crisis. The reforms that followed did the real work, forcing the country to rewire its economic DNA to compete on the global stage.